welcome to this very special edition of the Money Show. And yes, it's that time of the year when you want to think about your next year's strategy and also figure out what were the hits and misses in this particular financial year that might have impacted your investments. But when we talk about investments, do you really have to get swayed with the volatility of the market? How should you really be behaving for 2026 and what are the important triggers for your portfolio? Let's discuss all of this with the man himself and the man of the hour, Nilesh Shah of Kotak Mutual Fund, who's there with us. Hi and welcome to this very special show. It's a wrap-up of 2025 and also preparing our viewers for 2026. But before I begin, I want to know how was this year for you? From as a AMC head, as an investor, personally, the resolutions that you had set for yourself in 2025, were you able to figure it out and complete it for you? Was it a tick mark?
So, like as always, you start with many resolutions.
Absolutely.
And over the course of the year, some gets completed, some gets fallen out.
Totally.
But 2025 was a year where investors got return well below their expectation in equity, in fixed income. And only one asset class delivered far better return than expectation, which was precious metal. So again, it just reminded investors that how difficult it is to predict future. If you had asked us in 2024 end, what would have been our outlook? I mean, we would have gone wrong by a margin.
Okay. I mean, that's nice. But then when we talk about misses, what were the resolution that you missed on all the three fronts then?
So essentially, one resolution at this age is about your health. You do something and you forget something. The second resolution is to be far more, a balanced person. Don't get swayed by emotions. Be more rational.
Yeah.
Now, experiences taught us a lot, but you still end up having weak moments.
Right, definitely.
So again, the resolution remains the same. Execution is key.
Absolutely. And being a better person, I think, is the goal, from all perspective, if you look at it. But having said that, you've been in the markets in such a long time, so many decades experience you have. Every time it's a new learning for the investors whenever there's market volatility. Now, when we talk about post-COVID, definitely there was new investors joining in the market. For them, it's the new movement in the market, a new momentum of the market, which they are also learning. 2025 was a great learning, I believe, for all the new investors who entered post-COVID. But you, with someone so much of experience, was there anything new about the market that you also learned?
So one, the consistent selling by promoters through IPO, QIP, OFS, that was probably a bit of unexpected.
Okay.
The quantity as well as the quality of IPOs which came, they were well ahead of our expectations.
Really? Okay.
But more the merrier.
Yeah.
You can still do your own selection and pick up what you think is appropriate.
Right. So you don't think it's like a frenzy or people just going gaga over it and just picking up whatever is trendy. You don't see any risk over there?
I think SEBI has done a great job in ensuring that real quality businesses come out with IPO.
Right.
A lot of them are privately funded companies. So I think quality of business is fine.
Right.
It's the valuation where each one will have to take their call.
Right. But let's talk about the equity game, okay? So people, I think SIP guys have been the hero, okay? This entire year we've seen SIP numbers reaching record high and, the constant momentum of putting money in small amounts has really caught on now. And post-COVID, I think that is something that people have really understood about markets very well. Now, having said that, equity, they got returns of an FD, but look at the SIP people. They have really sustained and in fact, they are able to hold the Nifty also to this level. Now, having said that, is this likely to continue in 2026? The reason why I ask now is the initial stages, the momentum and interest in the market was definitely seen, but now there is also exhaustion and, expectations not being met from an investor's point of view. And if this continues, we can see a small blip, even in the SIP heroes. What do you say, or how do you analyze this?
So again, if we see the returns this year in equity is lower than expectation.
Right.
But the expectation of better return continues to remain.
Oh, that's totally there, yeah. Yeah.
And even people who are selling equity are not doubting India growth story. Their concern is on the valuation. My feeling is that if people moderate their return expectation, then they will continue to do their SIP because it still delivers better return than inflation. It still delivers real return. More importantly, investors have gone through all the ups and downs of the market, and they have realized that SIP returns can go negative also for a short term, but over a period of time it delivers real return. So today, as the financialization of savings happen, I think investors have become matured. The SIP trend is likely to continue.
Let's talk about companies now, and also let's look at large and mid and small cap. These three very important categories where we saw this team coming out of mid cap and small cap category in between, but then again, especially if I talk about SIP numbers, they have seemed to be quite holding. I mean, it's not a disappointment that, oh my God, people have gone away from mid cap. No, that has not happened. So the initial narrative where, people were asked to shift their money in large caps, yes, money going in large caps and flexi caps, definitely, but mid cap, small caps are also holding on. Now, talking about the company's valuation and quarter earnings, too much of thrust on Q3 and Q4, okay, and that's going to set the tone for 2026, I believe. How are you looking at it?
So, last 6 quarters earnings were single digit, below expectation from the valuation point of view. But now with so much push given by government on consumption, tax rebate of 1 lakh crore every year, GST rebate, tax cut of about 48,000 crore net this year, 96,000 crore next year, interest rate resulting into EMI burden reduction of 1.5 lakh crore plus, the 8th pay commission coming into play from 2027 beginning, and most importantly the ban on gaming, that is also putting money in the pockets of consumers.
Totally.
If this money is, let's say, spent on buying Apple iPhone, Indian economy will benefit a little. But if this money is spent on buying Swadeshi goods and services, the economy will get a momentum.
True.
It will create a virtuous cycle of consumption, creating investments, and investments creating jobs, which will result into consumption.
Okay.
So going forward over next 6 quarters, we think earnings growth has good chance of going into double digit. And that earnings growth with lower valuation after 1 year of underperformance should provide decent return in the market.
Okay, okay. But having said that, now what kind of, obviously, every time we talk to you and, you always try to teach our viewers that hold on to good companies, hold on to good fundamentals and good promoters out here. But, in a year where there have been geopolitical tensions, trade tariff, yet we are yet to get the clarity on that front also. But also a year where we saw SIP numbers going high, demat accounts holding up high. When we talk about selection, company selection, what should we be ideally looking at in this new changed world, if I can say that?
So was geopolitical tense earlier also? Answer is yes.
Right.
It was not as entertaining with President Trump, but it was as tense as before. Whatever we can imagine going forward has already happened in the past in terms of geopolitical risk.
Okay.
So there are things which we can manage, there are things which are beyond our control. We could not have predicted Operation Sindoor, we could not have predicted Russia-Ukraine. But what we can predict is our portfolio and our companies. Are they running business where return on equity is more than cost of capital? Are they running business which is free cash flow generating? Are they running with governance framework which is acceptable to you? And finally, is the price reasonable, having some amount of margin of safety? So if you keep things simple, good business run by good managers, available at good valuation, that should give you decent return.
Good to go, good to go. So is this also a year where you should not be taking too much of risk in your portfolio? I remember every year in the beginning and in the end, we talk to you and just try to get your help on how the lay of the land should be placed in the portfolio. So definitely avoid too much of risk, diversification, asset allocation. That's become the norm, I think, now.
Kavita, risk is according to your appetite. I probably can't eat one gulab jamun. That's my limitation. But someone can eat 10 gulab jamun and, still remain fit. So I can't benchmark myself vis-a-vis his risk appetite. I have to understand what am I capable of. So take risk, what is appropriate to you. If we look at 2026, we still think in fixed income, carry is more important. Rates have inched up a little despite policy rate cuts, but focus on carry. And performing credit AIF is one space where investors can still get double-digit return in fixed income with reasonably less volatility. On precious metal, we have seen one of the best rally, almost unbelievable. We still have positive outlook on gold and silver, but nothing compared to last year's return. But two things one will have to watch regularly. Is central bank buying gold and silver or not? If they turn out to be seller, you need to sell your gold investment much, much earlier. So focus on their activity. The prices have been driven up by their buying, and they will continue to have disproportionate influence over both precious metal price.
Right.
Focus on technology also.
Okay.
Like lab-grown diamond came and destroyed natural diamond price. Something like that, a technological innovation on manufactured gold or silver could have impact on real gold, silver prices.
Okay.
So central bank activity and technology innovation, you need to be careful about. That will give you your positive outlook on gold and silver. Equity, we are positive, but with moderate return expectation. Last 5-year return was 16% broad market and 20% plus small and mid cap.
Yeah.
That's not likely to occur in next 5 years. So moderate return expectations in equity, and within this outlook, you chew what you can afford to bite.
All right. And what about rupee? Is that going to be a dampener in your financial planning and portfolio planning?
So rupee is depreciating. It's on a weaker wicket, but it's not as if it's a dead end like 1991. We still have little under $700 billion FX reserves. The balance of payment and current account deficit is reasonably under control. God has been kind to us as oil prices are hovering around $60 a barrel. So rupee is a concern undoubtedly because of its movement.
Right.
But is it something which will be a showstopper? Answer is no.
Answer is no. Clearly, that is how it looks like. But then this has also been a year where people have really experimented with their investments, NFOs and new theme funds. Do you think that's likely to continue in the mutual fund space also?
So the larger companies' ability to launch funds will get restricted, as we can only launch one large cap or one mid cap or one small cap fund.
Yeah.
But we are seeing expansion in new asset management companies coming into play.
Yeah.
As all those new companies come, they have entire field available to them, so they'll continue to launch their product.
You think the penetration that we are looking at, especially the B30, yes, definitely there has been a significant jump post-COVID, and I think digital infrastructure has got to do a lot with it. The penetration, it's one-click SIP, but there is one-click stop SIP also.
Yeah.
How are you looking at that?
So many a times MFI data people consider gross and net. But please remember that any SIP which is stopped or which matures is going into the stopped SIP. And even if they make a new SIP or continue the old SIP, renew the old SIP, it is counted as a new SIP. So this data kind of does double accounting on both the sides, stoppage as well as new entry.
Okay.
The digitization has really helped in spreading SIP culture, and so also SEBI's investor awareness program. Mutual fund Sahi Hai is now becoming a household name. So we are seeing benefits of one, word of mouth publicity where existing SIP investors are recommending. Second, MFI and SEBI's investor awareness program pull. And finally, the digitization has made cost of reaching out to customers much lower.
Absolutely.
It's now very convenient to enter into SIP. Put all these things together, we are seeing SIP expansion. It should continue going forward.
Okay. Any specific measures on the fund level that you might want to take to penetrate deeper in B30? Are you looking at that market
So
now?
B30 is a place which is combination of physical as well as digital.
Okay.
You need branch presence,
Yeah.
feet on the street to connect with distributors and investors.
Right.
And there's also next gen in B30, which will come on the digital side.
Right.
So any company going pure digital, pure physical may not be appropriate for B30. You will have to really combine physical and digital together to reach out to B30 towns. One more interesting thing is the awareness about financial literacy. In B30, many a times, that kind of talent is not available or as financially literate as one could get, let's say, in urban India. So you'll have to train your people properly so that they become more effective, more productive.
Okay. So, when we talk about mutual funds, and definitely people have now started understanding the concept of it a lot, especially the youngster that we talk about. A lot of time I get on the show, where they want to invest in a mutual fund, but also treat it like a stock. Okay.
Yeah.
So, yes, the awareness is there, but the investing mindset has still not penetrated over there. So that's one area where people like you and we are just trying to work to this platform. But having said that, we are looking at trends, like for example, passives, they are going to go big. A lot of people are talking about that. ETFs is going to be a major trend where people are going to buy through passives. Do you really think we are closer to that Western world trend of buying passives and maybe going more passive than active in our investment portfolio?
So globally, fund managers are underperforming benchmark index.
Right. Yeah.
And hence people shifted money from active to passive. As long as Indian fund managers can outperform benchmark index, I think active fund managers and active funds will continue to find a place in the portfolio. But when you compare active versus passive, do understand the limitation which active fund managers operate in. In index, there is no cash. Every fund carries between 2 to 5% cash. If you assume 5% cash and market goes up, let's say 15% a year, 75 basis point hit occurs to performance simply because you are carrying cash to meet day-to-day redemption.
Right.
In index, stocks goes in and goes out at closing price.
Right.
We have to have impact cost because now we are managing 50 lakh crore plus in the equity as such. In fund, you can't go above 10% in a stock. In index, you could be 15% also if need be.
Yeah, totally.
Now that does create underperformance for the funds.
Yeah.
And finally, there's transaction cost in fund. If I have, let's say, a small fund of 200 crore and I get 1,000 crore subscription, I'll have to buy 1,000 crore worth of stocks.
Right.
There's a brokerage, there is STT, there's transaction cost.
Right.
All those expenses get built into the fund, and hence my return comes down. I think when an investor invests in passive fund, he's likely to underperform index. When an investor invests in active fund, there's a chance that he may generate more return than index. So both active and passive will coexist in an investor's portfolio.
Totally. And these days, I think the multi-asset allocation fund, if we talk about the hybrid category, that is really making a mark.
So, if you are rich, private bankers and wealth managers,
in association with Bank of Baroda, play the